Given the stock market's subpar performance over the past decade and the hit many investors took when stocks melted down during the financial crisis, it's understandable that many investors are still wary of equities these days. But some may be taking risk aversion too far. For example, a Merrill Lynch survey of 1,000 people with investable assets of $250,000 or more, released earlier this year, found that nearly as many young investors as old ones described their risk tolerance as low. This and other research showing similar wariness on the part of younger investors has some advisors wondering whether we could be witnessing the emergence of another depression generation. Time will tell whether that turns out to be the case, but even the possibility highlights one of the more intriguing and troublesome paradoxes of investing. Namely, sometimes in our zeal to avoid risk, we actually put ourselves at greater risk. How is this possible? Well, consider the case of someone investing for retirement who, after watching his retirement savings take a big hit in 2008 and early 2009, has decided to plow his nest egg into something stable like money market funds or treasury bills. Well, if the danger of losing principal were the only risk someone investing for retirement had to protect himself against, such a move might make sense. But while huddling in the most secure investments might ensure that you would never lose a cent of your money, it would also ensure that your retirement stash earned a pretty measly return. Short-term treasury bills, for example, recently yielded less than 0.2%, while bank savings accounts and short-term CDs have been yielding roughly 1% or less on average. If you're trying to accumulate a decent-sized nest egg for retirement, or live off one you've already built, those kinds of returns just won't cut it. So while you may feel safer in the short term, you may very well be putting yourself in jeopardy of not accumulating enough savings for a secure retirement, or running through your money while you've still got a lot of living to do. So when gauging investment risks, don't just consider the potential for short-term loss. Consider the long run too, and specifically the fact that investing too conservatively may not provide the financial security you'll want in the years ahead. To evaluate the trade-off between safety now and security down the road, you can check out Morningstar's Asset Allocator tool, which is available free in the Tools and Calculator section at troprice.com. So whatever age you are, the next time you're feeling anxious about the financial markets, don't automatically move all your money to investments that offer stability of principal. Doing that may make you feel like you've dodged a threat today, but you may also have increased the odds that you'll face an even bigger risk in the future.